Hey guys, it is Julie here with TipRanks. Today we're taking a look at 3 stocks that combine dividends and growth. So let's get into it. Alright guys, welcome back. Thank you all so much for being here and happy Friday. I had to bust out the Boston Bruins shirt today as NHL preseason has started, so very excited for the return of the hockey season. Let me know what team you'll be cheering for in the comments down below. Now today, we're going to be taking a look at 3 stocks that all pay a healthy dividend, plus analysts think have the potential for some good future growth. We'll take a look at these companies, what it is that they do, and what analysts are predicting for their stock's future. And we are in the final days of TipRanks sale, where you can get 40% off premium subscriptions. So if you've been wanting to unlock some fantastic investment research tools, now is the time to do so. There'll be links pinned in the comments down below. Now let's get right into our 3 dividend and growth stocks. First up on our list today, we're taking a look at Hasbro. Their stock trades under the ticker HAS, currently priced above $66 per share. Year to date, their stock has seen growth of 11%, including notable growth of 29% in the last 6 months. They do score an 8 out of 10 on the TipRanks Smart Score, with some bullish blogger sentiment and increased hedge fund activity. Hasbro is a pretty well-known toy company. They are amongst the most recognizable card and board game companies in the US, with the mission to entertain and connect generations of fans through the wonder of storytelling and exhilarating play. Monopoly, their #1 game, holds the Guinness World Record for being the best-selling board game of all time. But Hasbro is also the name behind many other popular toys and games, including Transformers, Play-Doh, Nerf, Dungeons & Dragons, Peppa Pig, and My Little Pony. Now, the Hasbro stock has struggled in recent years, and you can see that slow decline that their stock took over the last few years, with this recent recovery just happening. But analysts seem to remain optimistic about future recovery. One analyst from Stifel did recently increase their price target. The analyst stated that while the stock has been a relative laggard over the last several years, the pendulum has started to swing the other direction. They argue that no company is undergoing more change currently than Hasbro within their coverage universe. Based on their analysis of the key changes and opportunities, the firm is increasingly more bullish here. And taking a look at their dividend, Hasbro has been paying a dividend since 1977. Their current quarterly dividend is 70 cents per share for a dividend yield of 4.29%, and their ex-dividend date is coming up in about a month on October 31st. They shared their most recent quarterly earnings report on August 3rd, and they did fall short of analyst expectations, but to provide several updates. For their Q2, they reported revenue of $1.21 billion, and that did come in ahead of analyst expectations, but fell nearly 10% year over year, and their earnings per share of 49 cents did miss expectations of 56 cents per share. However, the stock did rise on the news that they had an agreement to sell their E1 film and TV business to Lionsgate. They noted that the sale would allow them to focus on their core toy and game expertise and strengthen their balance sheet. The Hasbro stock does come in as a strong buy, and that includes a new buy rating that just was initiated by Morgan Stanley a few days ago. That analyst noted that they expect upward earnings revisions as new management executes on their strategic plan to simplify Hasbro's business, cut costs, invest in innovation, and drive core top-line growth. The Hasbro stock comes in as a strong buy with 6 buys and 1 hold, with an average price target of over $84 per share. That would be an upside potential of 27%. And down below we can see our recent ratings, the low end being a buy from a couple months ago at 13% upside, and a high end price target from Stifel with an upside of over 41%. Second on our list today, we're taking a look at car conglomerate Stellantis. Their stock trades under the ticker STLA, currently priced at over $19 per share. Year to date, they've seen growth of 44%, including growth of nearly 17% in the last 6 months. They score a 9 out of 10 on the TipRanks Smart Score. Stellantis is the automotive group behind a handful of well-known car brands. Stellantis is a constellation of 14 iconic automotive brands and 2 mobility arms. Some of their brands include Alfa Romeo, Chrysler, Dodge, Fiat, Jeep, Maserati, Peugeot, and Ram. Of course, the company is on board with the EV movement as well. They're setting course for 100% of sales in Europe and 50% of sales in the United States to be battery electric vehicles by the end of this decade. They plan to offer more than 75 battery electric vehicle models and reach global annual sales of 5 million units by 2030. Now, the Stellantis stock does have an attractive dividend yield, but the catch is they only pay that dividend out once per year, so some patience is required. Their latest annual dividend was $1.41 per share for a dividend yield of 7.2%, and that gets paid out in the spring. Stellantis has recently seen an increase in hedge fund activity, including a new position from Michael Burry's fund. In the last quarter, hedge funds increased their holdings by nearly 250,000 shares, and that included a new position from Scion Asset Management of $5.7 million. And Stellantis does their earnings a little bit differently as well, as we don't get a quarterly report for them, rather every 6 months. And the latest came out near the end of July, where they had a notable earnings beat. For the first half of 2023, Stellantis reported earnings per share of $3.75. That was nearly a whole dollar ahead of analyst expectations. And their net revenues of 98.4 billion euros grew 12% year over year, and net profits of 10.9 billion euros was up 37%. Their management noted that their outstanding performance in the first half of this year supports their long-term sustainability and their ability to achieve their bold ambitions. They are well positioned for the remainder of 2023 and beyond. The Stellantis stock has attracted 12 different Wall Street analysts and currently comes in as a strong buy with 10 buy ratings and 2 holds. Analysts' average price target comes in at $23.69 per share, which would be a growth potential of 22.5% from current prices. And we had some recent ratings coming in just this last month. On the low end, we do have a hold with a downside of 6%, but others around 15, 21% to a high-end price target of over 48% upside. And third on our list today is Metlife. Their stock trades under the ticker MET, currently priced at $63 per share. Overall, in the past year, they are up 7%, but year to date, depending when you started here, would be down 10%, crawling back recently as they're up over 12% in the last 6 months. They do score a 10 out of 10 on the TipRanks Smart Score, with some notable increased hedge fund activity and positive crowd wisdom. Metlife is a global insurance company. They are among the largest global providers of insurance and financial services to individual and institutional customers. They offer life insurance, annuities, employee benefits, and asset management services. They have a strong presence in more than 40 markets globally, and they do business with 96 out of the top 100 Fortune 500 companies in the United States. Earlier this month, one analyst from Jefferies upgraded their rating on the Metlife stock to a buy. The analyst turned more constructive on U.S. life insurance, saying that the macro and market environment is generally more positive for the sector today than it has been since 2012. They expect them to benefit for higher for longer interest rates, and they noted that Metlife is one of the worst performing stocks in the space despite asset class performance that has been stable. Metlife initiated their first dividend back in the year 2000 and currently pays on a quarterly basis. Their most recent quarterly dividend was 52 cents per share for a dividend yield of 3.23%, and that was paid out on September 14th. They shared their latest quarterly report on August 2nd, and they did come out with mixed results, missing on revenue but an earnings beat. For their Q2, they reported revenue of $16.6 billion, and that did grow nearly 7% year over year, but fell $290 million short of estimates. On the earnings side, they reported $1.94, coming in 4 cents ahead of expectations. Wall Street analysts seem to be in agreement on the Metlife stock, as we have 10 unanimous buy ratings. That strong buy rating comes with an average price target of $78.60, which would be a growth potential of 24.5% for the next year. And down below, we can see a lot of 4- and 5-star analysts weighing in. At the top here, we have that upgraded rating from Jefferies with an upside of 14%. No real drastic low-end price targets here, though. They're all pretty close together. The low end would be a 15% upside from a few months ago, many around that 20 to 30% upside with a high end of 34%. So there we have 3 strong buy stocks, all paying out a dividend and all with some pretty bullish price targets from Wall Street analysts. Let me know your thoughts on these 3 companies in the comments down below and whether you agree with those analysts or not. I always appreciate hearing from you guys. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, just keeping you up to date with what those analysts are looking at and providing some information and entertainment. So please always do your own research and due diligence. Thanks so much for watching. I hope you guys have a great day, and I'll see you back here next time.